All right, so I got a question for you guys. How safe is your stock portfolio? What I mean by safe is you invest in specific stocks for whatever reason and you hope to get a specific output. How likely are you to get that specific output? And I've thought about this a lot when I looked over my portfolio for the past couple of weeks, especially because I have a lot of stocks that I invested in because they pay high in dividends. More importantly, I have a lot of stocks that pay high dividends every single month. And when it comes to monthly dividend stocks, you have to be really concerned about how safe they are. I came across a video called How to Tell If a Stock's Dividend is Safe by Learn to Invest, and it really shined a lot of light on metrics to look at that I knew were important and other metrics I've never thought about. So this video is inspired by that one. I'll leave a link down below. And today I'm gonna go over some information and tell you my top 3 safest monthly dividend paying stocks. Let's get started. What's up everyone, my name is Darren Jackson. Hopefully you all are having a great Thursday so far. The week's almost over, so that's actually pretty amazing. And today we're gonna talk about safe stocks. Again, safe stocks are super important. That's something I didn't really think about in the past, but it's super important now. It would have kept me from making mistakes such as investing into 4 shares of IVR because they originally paid about 50 cents a month per share, and then it dropped down to 3 cents and I lost $1 per share. It can keep you from making decisions such as that when you understand what metrics to look at to determine if a monthly dividend stock is safe. And I personally think that researching into stocks, especially if they pay high dividends, let alone monthly, is ridiculously important because let's just say you have a stock portfolio and it pays you a lot of money. Let's say you make $1,000 every single year, which for a stock portfolio at a decent dividend yield, that's a decent amount of money, and that's a pretty good accomplishment to make. But let's say you lose $800 every single year. So then overall you're only gaining $200. So the question is, was it really worth putting all your money into stocks that aren't doing so well but pay monthly dividends with the potential of dropping their dividends? Not so much. So that's why I've made recent videos about growth dividend stocks that you should invest in that may not pay as high of dividends, but will probably pay the dividends for a long time. I'll leave that link right up above me. And that's why I made this video that again was inspired by another video about Learn to Invest. And speaking of this video, in today's video breakdown, we're gonna go over the 3 metrics that I'm using to determine out of the 3 stocks that I'm listing, which one is the safest. And then we're gonna go over those 3 different monthly dividend paying stocks. I'll give you a little bit of details on them and it will determine how safe they are. So before we get into my top 3 safest monthly dividend paying stocks, I want to give you guys some insight on what metrics that I'm using. So the first one is the PE ratio, or the price to earnings ratio. And the way you get that is by taking the current share price of a stock and dividing it by the earnings per share. The earnings per share, I believe, is the dividend yield divided by the number of stocks. I believe that's what that is. But essentially, the lower the PE ratio is, the better in some cases. So basically, the PE ratio can give you an idea of how valued the stock is at that current time. So the lower the PE ratio is, the more potential it has to be undervalued. So that means that it's probably a great time to purchase it. And the higher the PE ratio is, the more possibility that that stock is overvalued or it has a lot of potential. For example, I'm pretty sure Tesla's PE ratio right now is ridiculously high. But again, if you've done at least a small bit of research into the stock, you understand there's a lot of potential behind it, which is why the stock price is driving up so fast. The 2 other metrics we're going by go hand in hand. It's the dividend growth and the earnings growth rate. So with the dividend growth rate, it sounds like exactly what it is. It's just tracking the dividend growth that the stock has within the last 5 years. And the earnings growth, again, is the same thing. It's tracking the earnings growth within the last 5 years. And paying attention to those 2 metrics together is very important, because if you have an earnings growth of 10% a year and a dividend growth of 10% a year, you have a very consistent stock, very consistent. And that should show you, again, with a medium to low PE ratio, that's the stock you want to invest in. However, if you have an expense ratio that's decreasing and a dividend payout that's not doing anything, it's stagnant, they expect that dividend to go down. So that might mean the stock is a little bit unsafe. So those are the 3 metrics that we're going by. And with that being said, my 3rd safest monthly dividend paying stock is ticker symbol DIV. Now, DIV is a market cap weighted index that basically tracks every stock within the US. And what attracted me at the beginning about this monthly dividend paying ETF, besides that it pays monthly, is that the dividend yield was at about 10%. So that means, considering the price that it is, it pays out about 10% every month. Now, it's been pretty consistent for me so far. Granted, I haven't had this stock for a while, but after reviewing some of the metrics, I came back with some surprising information. So it looks like a couple of months before I purchased the stock, the dividend was slightly decreasing. And if it were to continue the regular 10 cents a month payout for the rest of the year, then that means it'll pay out about $1.40 for the remainder of the year, in comparison to what it was in 2016, which is about $1.60. So with that being said, its dividend growth rate was at about 0.84, which isn't horrible, but it's not good either. You definitely want a number that's over 1, or at least 1, which shows you that the dividend growth is consistent, or even better, it's increasing. So with the earnings growth rate, I also took into an account what the stock price was doing even with this current pandemic. So all this information is completely current. So with that being said, the current price of this stock is about almost $16 as of last Sunday, so it could definitely be different now. And the price of this stock around this time 5 years ago was almost $25 a share. So you're looking at an earnings growth rate at about 0.64, which again, same idea of the dividends growth rate. The higher it is, the better. And this one's even lower. So it could have a potential of reducing. And FYI, even before this pandemic, the price of the share was decreasing. So that's pretty important to keep in mind as well. And that's why it's my third safest monthly dividend paying stock out of these three. At number 2, we have another ETF with the ticker symbol QYLD. I've mentioned this in a video before, so I'll link that up above. This ETF is pretty interesting. I'm pretty sure it tracks the NASDAQ 100. So it's the top 100 highest trading stocks. So you have stocks such as Apple and Tesla and Facebook and Google, et cetera, et cetera, et cetera. But it does options tradings on those stocks every month, and it collects a premium, which it then distributes out to its shareholders in the form of dividends. So I thought that was kind of cool as well. On top of that, it has a 10.8% dividend yield, which means it pays about 20, maybe 21 cents a month. The PE ratio of this stock is at 33.5, so it's a lot less, which shows that it could potentially be undervalued, but overall, it is a way safer stock than DIV. When I check the earnings growth rate, the current price of it today is $22 a share, and the price of it around the same time 5 years ago was about $20 a share, which gives it a earnings growth rate of about 1.06 or 1.07. That's great. That means even with everything going on right now, this stock is slowly increasing, very slowly, but slowly nonetheless. So you're getting the growth and you're getting consistent dividend. Now, speaking of dividend growth, the dividend yield right now, if it continues on the same path, will be about $2.70. And what it was 5 years ago was about $2.40. So you're looking at a 1.32 dividend growth rate, which again, amazing. You have a consistently expense growing dividend paying stock followed by a growing dividend yield. That should give you some confidence that a stock like this is going to consistently grow and you don't have to worry about losing a lot of money over a long period of time on top of the monthly dividend checks that you're going to be getting that you can reinvest for more growth. So this ETF is very safe, but there's one ETF that above all is the safest ETF that I have, at least between these three. And it's actually an ETF that you guys probably hate that I talk about, but I don't care. I'll go quickly through it. It's SPHD. It tracks the 50 least volatile stocks within the top 75 highest dividend paying stocks within the S&P 500. So it's safe within dividend paying. Its PE ratio is at 16. It's been pretty low for a long time. It pays a 5.45% dividend yield, and it actually has the highest price per share, which makes it pay a 15-cent dividend per month. And that's been pretty consistent for the past year that I've had this stock. Now, this stock came pretty close as far as safety level with the QYLD stock. Its dividend growth rate is at about 1.22. If the rest of the year panned the way out as it is, it'd be about $1.83 of a dividend payout per year in comparison to about $1.40 that it was paying around the same time last year. So that metric is a little lower than QYLD, but it's still pretty high. And as far as its growth, its current price is at about $33, almost $34 a share. And 5 years ago, at around the same time, it was at about $32 a share. So you're looking at about a 1.1 expense growth rate. Now, as you can see, in comparison to QYLD for those growth rates, it is a bit lower, but it's the PE ratio that makes this ETF, in my opinion, way safer than QYLD. And one other thing makes it even safer. So I said at the beginning, when I'm comparing the expense ratio, that I'm taking into an account the drops that every stock was going to make due to this pandemic. But for this stock in particular, if you take into an account where it was prior, the prior price before its hard drop was at about $44 a share. So if you keep that in mind with 5 years ago, where again, it was at about $32, then your expense ratio is at almost 1.4. So if you do the research and understand what type of stocks this ETF holds, then you understand how safe that stock is and how much potential of growth that it has, considering where it was just a couple of months ago. So that's why it's my safest ETF. So hopefully this gives you some more insight on what to look for when purchasing a monthly dividend paying stock, because they are some serious stocks to invest in. They can make you or break you. It's just up to the research that you do, but they're fun stocks to invest in. And this is obviously not all the information you can research. Again, I'm gonna link the video that inspired this video down below. You can watch that video. I would recommend you to. Hopefully it gives you a lot of extra information, but I appreciate you guys watching, and until next week, take care.